Are you wondering how to make money in equity crowdfunding? Well, today we're going to dive into that very topic. We're going to understand what equity crowdfunding is, what it isn't, what the different types of it are, and don't dip out early because I'm going to talk about the number one tip that you should remember when you're making equity crowdfunding investments. Okay, first, what is crowdfunding? So crowdfunding at its core is leveraging the masses to fund your project, your business, whatever it is you're doing. Right? You're probably familiar with sites like Kickstarter and Indiegogo that have really brought this whole idea of crowdfunding to the forefront. Or maybe you're familiar with companies like WeFunder, Republic, and Start Engine that have done a lot to bring equity crowdfunding to the masses. Essentially, the way crowdfunding works is entrepreneurs will list different projects or their company on platforms and then provide an opportunity for your average day investor to put money in and support their cause. In exchange for that support, that monetary support, they provide different types of things. So in the case of equity crowdfunding, they may be giving you a piece of their company. In the case of just normal crowdfunding, like on Kickstarter, they may be giving you some type of reward or thank you gift in exchange for your contribution. Let's dive into each of these. So I like starting with Kickstarter because they were really the first ones out there to launch this concept of crowdfunding. And on Kickstarter, you have the opportunity to help these companies launch their product, which it can be really satisfying and really cool, and a great way if you're an early adopter to get access to some of the latest, coolest technology. I love Kickstarter because for me as an investor, one of the things I hate is telling entrepreneurs no. But as a good investor, you tell a lot of entrepreneurs no, which is, it's kind of a bummer. But what is great is being able to go on Kickstarter and see these amazing ideas and companies that maybe I would never back as an investor, but that I would still love to support and see their ideas come to fruition. And so in a way, I can support them with, a $25, $50, $100, whatever it might be, investment in their company where my reward for investing is to actually get their product. And I've done this with all kinds of things, everything from art and photography and board games and all kinds of technologies, softwares, hardware products, etc. And that's really one of the fun things that you can do on the crowdfunding side of Kickstarter and Indiegogo is support those types of businesses. And in exchange for that, I've even leveraged Kickstarter as a way to get insight into how a company is doing and then later reach out to them to learn more about the business for a potential equity investment. Now, these platforms like Kickstarter, they charge a fee for listing on them. I think Kickstarter charges around 5% of a fee of the total amount raised. So if you raise $100,000, you're going to end up paying them about $5,000. But that's not all. It is a lot of work to run these campaigns. It's not like you can just lay up a shingle or a page on Kickstarter and then the money just starts rolling in. Usually it requires a lot of marketing effort on your side as well, where you're going out and you're spending marketing dollars to tell people about your campaign on Kickstarter and raising money through it and convincing them that they should support your product and help you launch your company. And there are a lot of different reasons why companies will list on Kickstarter. Some of them, they go on to it, and it could be that they're raising that initial capital to be able to put in their first order for product because that barrier is really high, right? They got to have a lot of money for that initial run of inventory. Or it could be that they're just trying to raise some additional working capital, right? Maybe they've got a pretty strong business, but hey, if people are willing to give you some additional money so that they can get their product before anybody else, and you can use that money to kind of help offset some of your operational or manufacturing expenses, why not? And in other cases, it's like, hey, I've got this idea for a product, but I don't know if it's the right one, and I want to list it on Kickstarter and see how well it will do. So a lot of good reasons to do it, even though there's no guarantee that you'll get product. Of more than 100 projects that I've backed over the years, I think I can count on one hand the number that haven't ultimately delivered. Okay, so that's normal crowdfunding. Let's talk a little bit about equity crowdfunding. So equity crowdfunding is where you're not just throwing up a product, you're actually throwing up your business for people to contribute to and invest in. And in exchange for their contributions, they're going to ultimately get some sort of security that will represent an investment in your business. There are basically two types of investments that you can make into one of these companies that is listed on one of these equity crowdfunding sites. You can invest equity, where you're an actual owner in the business, or you can invest debt, where you're providing a loan to the business. Now, even when you're providing a loan to the business, the vast majority of the time, that loan is what's called a convertible note or a SAFE. And a SAFE stands for Simple Agreement for Future Equity. It essentially is a convertible note or a convertible debt. And what I mean by convertible is that you're lending money today, but your hope, what you really want, is for that debt to convert into equity at some future date. And the reason why you might do one versus the other is that with convertible notes or safes, you have a little bit of downside protection because you're lending the money. And so the company has an obligation to pay you that money back as long as it's a note. Once it converts into equity, now the company has no more obligation to pay you back because they don't owe you anything. What they did is they paid you in the form of shares in the company. And so now you are an owner in the business. Now, if the company gets acquired, right, then they have an obligation to pay you your ownership percentage of the company. And the operators of the business also have a fiduciary responsibility to their investors to make sure that they're putting forth their best efforts to help run the company and make it successful. Some of the terms that you should be aware of with a SAFE are the cap and also the discount rate. So the cap is simply the maximum valuation at which your investment will convert at. And this is important because what you don't want to do is invest in a company really early when it's really risky and you take a ton of risk on the business. And then you didn't have a cap on valuation. And so the company ends up being super successful. Lots of investors want to throw money in and the valuation goes up super high and your investment converts at that same valuation as all those other investors that came in way later at a much lower risk. And so you want to get in early and you want to have some sort of cap on the valuation at which you will invest that represents the amount of risk that you're taking on. Now, the other thing is, what happens if they raise money at a valuation that's lower than that cap? Well, you still want to be rewarded for the risk you took, and that's where the discount comes in. So oftentimes you'll see somewhere between a 10 and 30% discount to the next round. And what that means is, let's say the company raises at a $10 million valuation and you have a 20% discount, then your investment will convert at an $8 million valuation, whereas everybody else will invest at that $10 million valuation, thus giving you a little bit of a reward for coming in a little bit earlier and taking that additional risk. So that's SAFEs. Let's talk a little bit about equity. So in a lot of cases, you can invest direct equity in the company where you are buying shares of the company, pure equity. Now, some things that you should be aware of there. There's going to be a valuation on the company, and there's also going to be a type of share. So the most common is common shares. Common shares are called common because ultimately they are the same for everybody that owns them. And they typically represent founders, employees, anybody that's kind of running the company typically receives common shares. And an investor in equity crowdfunding, most of the time companies will be selling common shares when they raise equity. There is another type of share called a preferred share. And this is the type of share that most venture capitalists will demand to invest in. And the reason for that is because it comes with a bunch of different rights and voting privileges. So for example, it may come with the right to have a board seat, or it may come with liquidation preferences that give you some downside protection. Or it might come with ROFR rights, the right to invest more money into future rounds to maintain your ownership percentage. There could be a bunch of different rights, and that's why ultimately venture capitalists will demand to invest in preferred shares. Preferred shares tend to be a little less common in equity crowdfunding, and there are a lot of reasons for that. But at a minimum, you should know which one that you're investing in. You should know what's the valuation and what type of security are you getting? Are you getting common? Are you getting preferred? And if you're getting preferred, what kind of protections and rights do those preferred shares come with? Ultimately, these investments are super risky. And whether you're investing in debt that ultimately converts into equity or you're investing directly in equity, you have to approach equity crowdfunding with the mindset that these are really risky and that in all likelihood, you're probably going to lose your investment. Now, here's the one thing that you should always remember when making equity crowdfunding investments, and that is valuation. Now, oftentimes, I've seen people, they get so excited about the product and the opportunity and the future and the potential and all of those things that they forget about valuation. I'll tell you a story. So one of my friends who is a very successful venture capitalist now that's worked at some of the very best venture capital funds in the world, when he was still a student of mine, came into my office one day and was like, I just invested in this super cool company through equity crowdfunding, and they're going to dominate the world and blah, blah, blah. And he was so excited about it. And I actually knew this company and knew them fairly well. And I was like, that's awesome. What valuation did you invest in? And he was like, I don't know. He didn't know. because the company hadn't been forthright with what the valuation was. And as we sat down and we walked through what the valuation really was and relative to the revenue and so forth, he had paid a very high valuation. And so my recommendation to you is make sure you understand what the valuation is and what the ultimate outcome potential of that company is. Sometimes I've seen companies that take advantage of retail investors because they don't really focus on valuation. They don't understand what it means and the impact it can have. And so I highly encourage you to spend some time really understanding that before you make an investment. If that was helpful, watch some of my other videos where we talk about valuation in more depth, like whether or not valuations will reach their 2021 levels ever again.